Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, our guest is Jeff Trapp. Jeff is a tax strategist and the founder of the Tax Planning Pros, operating out of Frisco, Texas, serving clients in all 50 states around the country. Jeff is an expert in tax planning, particularly for business owners, and joined us today to have a great conversation about top tax planning strategies for business owners, top mistakes people are making, a few things you can do to reduce your chances of getting audited, and other general tax savings tips. Jeff's been doing this for a long time. He knows a heck of a lot about tax planning and tax compliance, meaning the filing of your returns, the keeping of books and records and expenses. It was a very good conversation. I learned a lot, and I hope you enjoy it too. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Hello, Jeff. Welcome to the show.
Hey, Grant. Thanks for having me. I'm glad to be here.
We were just talking about tax planning, tax strategy kind of stuff, and I'm really excited to chat with you today about that because you know a whole lot about it. So why don't we start? Could you give everyone an introduction and maybe a little bit about your background and what your day-to-day looks like right now?
Yeah, my name's Jeff Trapp. I'm with a firm called the Tax Planning Pros. I'm the founder of that firm, and we specialize in helping business owners save money on taxes and really help them keep more of their hard-earned money by creating additional cash flow and a long-term wealth legacy. I've been in this business 16 plus years now, but I've actually been preparing tax returns since I was about 16 years old. And so I've been doing this a long, long time and been around this type of business for a long, long time.
At 16 years old, you were doing tax returns. How did you start at that ripe young age?
Well, that was about the time that I got my first job. And my stepdad was a tax attorney and CPA. And he said, well, you got your first W-2 here, so let's prepare your tax return. And so that's when I was off and running, preparing tax returns. I swore I would never get into this business because of the hours and, all the things that come along with being a tax professional. But, if you design your business the right way, it doesn't have to be so overwhelming and so scary.
So you started preparing your own return at 16 when you got your first job, and then thought you were not going to go down that road, and then you wound up there anyway. So did you study accounting in college? How did you find your way back to it?
Yeah, so I actually started out studying business and psychology, and then I went back to school after I got my bachelor's to get my accounting credentials and my accounting degrees.
Oh, good for you. And then did you have like Big Four firm experience like most accountants coming out of school?
Coming out of school, I actually was able to latch on with some regional firms in Southern California and got my feet wet there. Regional firms are, typically right under kind of your Big Four in terms of, they focus on a specific region or area of the country.
Mm-hmm. Gotcha. Okay, cool. So when did you start your current firm?
So the Tax Planning Pros started in 2017. I realized, working in these public accounting firms, they were just so focused on tax return preparation. They weren't really focused on the advisory and planning services of helping our clients actually save money on taxes. And, I had a partner at that firm when I asked, like, hey, why aren't we doing any tax planning? And the first thing he told me was, well, people don't pay for tax planning. We make all of our money on preparing returns. So we're just going to focus on that. And I'm like, well, you have this wealth of knowledge that you could pass on to people. And they absolutely just refused to do it.
So in my business, we see tax planning as vitally important. How do you, if you have somebody come into your office that is asking for you and your colleagues to prepare their return but doesn't see the importance of tax planning, what is your response to that? How do you describe the importance of tax planning?
Well, typically what we do, we're a little bit different than most firms. So we actually lead with our tax planning and tax advisory services. So if you come in and just say, hey, I want you to prepare my return, what we'll do is we'll diagnose and look at the returns and determine if there's any opportunities to save money on taxes. And we'll actually go through a tax advisory engagement where we will um, work on helping them minimize their tax bill and increase the cash flow. And then at the end of the year is when we realize the tax savings when we actually prepare the taxes. So we do it a little bit backwards, where we just don't prepare the returns, and we make sure that our clients are actually saving money on taxes year after year.
Okay. So if somebody comes into the office, they have their return that you review and look for opportunities. What does the process look like? And maybe we could start with
Yeah,
individuals and then talk about businesses secondarily.
yeah, great question. So typically, we'll look at the business and individual tax returns together, and we'll do an analysis on those. Uh, and during our onboarding process, our clients will provide us with those returns. We have a questionnaire and things that they fill out, and we typically do a kickoff call or a kickoff meeting with all of our clients, where we ask additional questions to figure out kind of what's going on. And then about 3 weeks later, we'll do kind of our high level tax planning overview of how we're going to save you money over the next 12 months. And that's really a 30,000 foot view call. And then the remainder of the year, we're focused on implementing those tax strategies, whether that's, setting up legal entities, taking advantage of certain tax loopholes, or, depending on what business they're in, depending on that niche, figuring out, are there additional strategies within that niche that we can take advantage of? And that's really our goal.
So from an individual perspective, what are some of the common strategies that come up? And let's set the business stuff aside for the moment and circle back to it. But just on an individual 1040, what are some common things you see as mechanisms to help people pay less in tax?
Yeah, when it comes to individuals, there's a number of things that you can do to save money on taxes. We want to make sure that folks are maximizing all of their deductions. So you have your above the line deductions and your below the line deductions, right? And your above the line deductions would be, contributing to your retirement accounts, contributing to your HSA, those types of things. Your below the line deductions would be, your home mortgage interest, your real estate taxes, charitable contributions, and things of that nature. And so that's what we'll focus on with individuals. We'll also focus on whether or not they want to make any additional investments, say in real estate or energy, and figure out a way to be able to take advantage of those write offs to maybe bring down that taxable income a little bit.
Gotcha. Okay. Do you see any common mistakes people walking into your office are making with regard to their own taxes? Is there anything that you just see over and over and over again that jumps off the page at you immediately?
From an individual perspective, I think you're probably okay preparing a return if you have one W-2. But, once you have additional information, you buy a home and do those types of things, you might want to start consulting with a tax professional to make sure that you're taking the right deductions, maximizing those deductions accordingly. Typically we don't see too many mistakes on the individual return unless it's on a Schedule C or a Schedule E. And Schedule C, if you don't know what that is, that's your business income and expenses. That's where that's reported. And Schedule E is where your rental income and expenses are reported. A lot of times, people will just be missing out on deductions that they should be taking.
Gotcha. Gotcha. So tell us a little bit more about the tax efficient investment opportunities. I suspect and you mentioned oil and gas and other real estate opportunities. I suspect you're referring to qualified opportunity zones.
Well, there's qualified opportunity zones to invest in, of course. You have your real estate syndications. You also have opportunities to invest in real estate, rentals, right? So there's a short term rental strategy where you could buy Airbnbs in a specific location. And, depending on the average length of stay, you might be able to qualify that as an actual Schedule C business, allowing you to deduct, the mortgage interest, real estate taxes, depreciation, management fees, etc., and offset your normal W 2 income. And usually, you're not able to do that when you have a real estate rental property unless you qualify as a real estate professional. And most people who have just a normal W 2 job do not qualify as real estate professionals.
Right, right. And for our listeners out there, what Jeff and I are what Jeff's referring to here is if you have a rental property that maybe kicks off $1,000 a month in rent, you have $12,000 throughout the year of revenue. You can offset that with expenses directly attributable to that property, like insurance and maintenance and all those things, and the interest that you pay on the mortgage. But if you have $15,000 of expenses and $12,000 of revenue, that extra $3,000 of expenses is a passive activity loss that you don't get to use to offset your W-2 income. But Jeff, what I hear you saying is that if the length of stay of your Airbnbs is above a certain threshold, and I think is it 7 days average length of stay?
Exactly,
Then you
7
can
days.
circumvent that limitation. Or if you're if you qualify as a bona fide real estate professional, that's another way to circumvent that limitation. And we've got a couple clients that have done that in the past, but I'll also add that in this environment, Airbnbs are not the cash flow kings that they were a couple of years ago, and it's looking a little suspect in a lot of regions around the country. I have no idea what it's like in Texas, but around here, it's a little harder to keep them rented.
Yeah, and I think you have to do your due diligence and be very, very careful where you decide to invest, that money and what area you decide to invest it in. And you probably want to find somewhere where it's a touristy area, probably something that's not regulated by an HOA, because the HOA can change their mind at any time and say, "Hey, this is no longer an Airbnb area." So there's a lot of things to look into, and it's not as glamorous, I would say, as you see maybe out there on TikTok or Instagram or things like that. There is a price to learn and a price to pay. And I was talking to one of my real estate investor clients, and he's like, "Yeah, the first 4 or 5 properties you buy, you're probably going to lose a lot of money on, but that's your education for getting into the business."
Interesting. Yeah, I can see there'd be a pretty steep learning curve there. So what about oil and gas? Can you elaborate on the tax benefits of oil and gas investing?
Yeah, so oil and gas investing's been around for a long time, and with our current administration, they're more focused on clean energy like solar and wind. But there's these partnerships and there's these opportunities where you can actually invest. Typically a minimum investment's about $100,000. You have to be an accredited investor, and so you have to have a certain amount of assets or adjusted gross income in order to qualify. But let's say you invest $100,000. Typically, you can take an $80,000 deduction against that $100,000. Plus, there's some intangible drilling costs and things like that you're able to write off against that. So, depending on your tax rate, right, at $80,000 times 30%, you're looking at about a $24,000 tax savings. And typically, if the well is producing and doesn't dry up. We've had clients where their wells dried up and they didn't get their investment back. You'll typically make your investment back and then some.
Yeah, interesting. That's less common in California, I would say, than Texas, but it's certainly good to hear about it. Let's transition to the business side of things. So you have a business owner who comes in. Now there's a lot more complexity to their financial profile, their tax situation, but also a lot more opportunity to save on taxes. What does your process look like when somebody walks into the office and they have their personal tax return, but they also have maybe a corporate tax return as well?
Yeah. So similar process, we do our kickoff meeting. We get all of the documentation. We ask additional questions, as we're going through the tax returns and different things. And then, 3 weeks later, we set up that additional 30,000 foot view call. And on that 30,000 foot view call, with businesses, there's, like you said, a lot more opportunities to, um, to increase your cash flow and pay less tax, right? Because, if you're a W-2 employee, you're paying the most tax possible in the country, right? But as a business owner, you pay the government last because you get to write off all of your expenses. So one of the things that we preach and teach here is, hey, know the common expenses for your industry and what the industry averages are. That's super key. And so that's as simple as, doing your accounting on a monthly basis, knowing what your cash flow is. I mean, it's just basic strategy, but it can be so important. And a lot of times, we find that people are commingling their business and personal bank accounts, right? And so they may be writing or buying things in their personal name that could be business write-offs, and they just don't know it. And we can find write-offs really quickly that way. But then we also go into, legal entity optimization. Is it, better to be a sole proprietor, LLC, C Corp, S Corp, partnership? And there's a lot of factors that go into play, especially when you consider, different states. Our company's licensed in all 50 states. So we have clients all over the country.
Yeah, there is definitely a lot to the entity formation and the industry to industry trends. And we run into that in our practice all the time. People have, it may have started out as a side gig that they grew and grew and grew, and now they're maybe quitting their full-time job to transition to this full-time. Keeping consistent books and records pays dividends more than you can fathom if you're in that situation, because you will get to a point where you really do want to dig into your financials and your cash flow, and you have all these historical records that are kind of useless to you until you go through this exercise. So just keeping the books as a starting point will kind of right size the financials in your business, and then allow someone like Jeff to look through them and really pick out where these opportunities are to increase your legitimate business deductions or change entities to something that's a little bit more favorable for you. There are just a lot of opportunities there. So Jeff, on the business side, is there anything? Do you see any common mistakes there? What are people doing over and over and over again that could be fixed easily?
Yeah, I mean, wrong legal entity structure comes to top of mind, right? You definitely need to consult with a tax strategist or advisor on what you should be. But a lot of times, switching that legal entity structure will save tens of thousands of dollars. If you're making between $500,000 plus, setting up separate legal entity structures is important too, because you can funnel income into something like a C corporation that's taxed at 21%. And so there's things that you can do there. Besides keeping good books and records, folks are missing out on the home office deduction all the time. And the big thing that I hear is like, well, my CPA says it's a red flag, right? But, they did a study a few years back and they said, well, if you're a business owner, you will get audited about 3.1% of the time. But if you have the home office deduction, your audits increase only to 3.2%. So that's a huge thing that people miss out on, right? Not depreciating property properly. So if you have business property, like you own your office building, you're making improvements, things like that. A lot of that stuff can qualify for bonus depreciation, get written off today versus waiting, 39 years. So these are things that we see on the tax returns all the time. And, I can look at a tax return and know in about 20 minutes, like what they're missing out on.
Yeah. A lot of the opportunities that we come across in my practice are regional and state specific, and the SALT deduction workaround is definitely one of them. We've talked about a fair amount on the show in the past. Are you working with clients across the country in different states than Texas?
Yeah, so we've got a bunch of clients in California that qualify for the SALT tax workaround. We've got New York City, New Jersey, So a lot of states, pretty much almost every state that has a state tax, you can qualify for the SALT tax workaround. One caveat I would say is, if you don't have good books and records, sometimes it's difficult to calculate the correct deduction, and you don't want to undercalculate that deduction and what you pay out of the business for the state tax. So, because you want to be able to maximize that deduction. So when that tax is due, and a lot of states it's due early on, like March 15th, you want to make sure that your books and records are up to date so you can maximize that deduction. Because folks who come in who have really, really messy books or don't have a proficient bookkeeper tend to miss out on the full maximization of that deduction.
Yeah. And as a side note, it's pretty easy to keep messy books, by the way. I mean, you can go a long time without ever having anybody challenge you on your books, right? And this is not something that's going to fix itself like every 3 or 5 years. You can go maybe a decade or a couple decades or more and have really, really messy books, but you're only shooting yourself in the foot when you do that. It takes a little bit of extra work to clean everything up and get it into an understandable and usable format. But until you really get audited by the IRS and then forced to justify all your revenues and expenses and so forth, there's no organization, no other organization or party that's going to force you to do it. And that's I can't stress enough how important it is to keep clean books. Now, for the benefit of our listeners, and apologies to those of you who have heard us talk about this on the show in the past, what Jeff and I are talking about here is the SALT deduction workaround. As a result of the Tax Cut and Jobs Act of 2017, in 2017 and prior, we used to be able to deduct 100% of our state and local taxes paid on our federal return. That piece of legislation, Trump's tax cuts, limited that deduction to 10 grand. And so the easiest way to explain this is if you're in California, for example, and you make $300,000 a year, round number, let's say you're paying 10% of that to the state of California's franchise tax board. That's $30,000. Well, as a result of the Tax Cut and Jobs Act, you're now only able to deduct the first $10,000 of that 30. So you lose out on the other $20,000 of deduction, which if you're in the 24% bracket, $20,000 of deduction is $4,800 in taxes. So the workaround, the solution is if you have a pass-through business entity like an LLC or an S Corp, you can have the business prepay your state taxes due and reduce your income from $300 to $270, which is the exact same thing as claiming the full $30,000 deduction. The logistics, Jeff, you know far better than I do about what forms you have to file and what kinds of estimated payments you have to make along the way. And it differs a little bit state to state because these are all local state regulations that dictate our ability to do that. But when we say the words SALT deduction workaround, that's what Jeff and I mean. And Jeff, what's the biggest tax benefit you've seen from this strategy? Last year we had one that was worth maybe 150 grand in tax savings to someone. What are you seeing out there?
Yeah, I mean, depending on your income level, I think probably 100, 150 grand we've seen for a few clients of ours when it comes to the SALT tax workaround. And like you said, Grant, here, every state has different forms that need to be filed, but they also have different due dates on when the taxes need to be paid. And they're not typically the tax due dates that you are accustomed to. It's typically upfront, an upfront estimation. And so, you want to make sure that you're staying on top of that and staying on top of your financial records to make sure you can maximize that, because it's a huge deduction, right? I mean, at $150,000, that can save, folks, 20, 25 grand in taxes.
Mm-hmm. Absolutely. So how do you stay abreast of all the local specifics?
Yeah,
50 states is a lot.
50 states is a lot. But, it's not like we have a client in every city or town. There's states out there like Ohio and Kentucky where they have like municipality taxes and things like that you have to stay aware of. And So we really just focus on our clients. So one of the things that we do is we meet with all of our clients on a quarterly basis. We review their business, their life, any tax changes. And so as we prepare for those calls with their clients, we go into our tax research software to make sure there's no updates, or if there are updates, we can inform them of those updates on those calls to make sure that we're all on the same page when it comes to filing their taxes.
Yeah. We had a question from someone recently about qualified small business stock. That's an area that I understand the benefits of, but the logistics and nuances are beyond me. Could you give us, and I know this is off the cuff, I didn't prep you for this at all. Could you explain what that is, what the benefits are, and how someone might go about qualifying for that strategy?
Yeah, I mean, so basically, if you're forming a company, and we see this a lot, like in the I don't know, kind of like the venture capital space, right? Where you're forming a C corporation, you're exchanging equity for money and things like that. But basically, what you can do um, is you form this entity, and if you formed it, I believe, as a husband and wife, you guys, when you sell the company, get to write off the first $10 million in capital gains per related party. So it can be really lucrative. So we'll see like C corporations that are formed with like husband, wife, they'll put their kids on there, right? Because each related party gets that write off. And so you can save a lot of money on taxes. I was just working on something like this with a client of ours, and I think we're going to end up saving them. Just with that strategy alone, something like $4 or $5 million in taxes.
Yeah. So what if you have a company formed already, is it possible to retroactively qualify for this?
It really depends on how it's structured. It follows the operating agreement and various elections that were made. If you already have a company, it's not the end of the world. We've gone back in the past and have been able to form new companies and do things like that to make sure that our clients do qualify for that.
And when you form a new company, what do you have to be aware of there? What specifically do you need to do to qualify for this?
There's various things that need to be in the operating agreement. There's various elections that have to be made when filing for the qualified business stock. There's certain time frames, right? So you can't form a company, um, today and then sell it in a year to be excluded. You have to own the stock and own the company for at least 5 years in order to qualify for this exclusion. And so timing and time frames is all very, very important. And it's just on a case by case basis. And it sounds real simple on the episode here, but it's a pretty complex strategy.
Yeah. Well, thanks for commenting on that. I know I didn't give you any forewarning about that one, but it just came to mind. So another thing that's been in the news here recently is the general funding of the IRS being very low. They, as part of the government debt issuance deal over the summer, I recall them making headlines. They were going to hire a bunch of new examiners and then give them all pistols, which made some funny headlines. And as I recall, I think they've backed off of that now. But it seems to me that given the relatively low level of funding, that your risk of audit is probably lower. But I don't have any stats or data to back that up. What is the state of the IRS now? What is your audit risk in general compared to maybe 10 or 20 years ago?
Yeah, that's a great question. And because of the COVID-19 pandemic, there's not really great stats out there in terms of IRS audits. I know when I was doing this 10 years ago, we were dealing with a lot more IRS audits than we are today, and that's really all I can speak about that. But in terms of the Inflation Reduction Act and the IRS needing to hire 87,000 revenue agents, that's definitely something that is still in play. They've made some revisions to their funding. So it sounds like they're going to run out of funding. It was supposed to be a 10-year plan, probably in year 5 or 6. But they're hiring people. Last I read, they hired about 6 or 7,000 new IRS revenue agents. They just posted some job ads last week for the IRS that they're looking for CPAs to audit S corporations and partnerships. So it's still out there on the horizon. And what I would say, as a business owner, if you want to avoid being in the crosshairs of the IRS, what you want to do is make sure that you keep good records. You keep your receipts for up to 4 years, right? And you can do a number of different things to keep those receipts. There's a lot of great apps to track your expenses and your receipts. You can snap a picture with your phone and email it to you and keep a folder in your inbox, things like that. But as long as your record keeping is good, you really have nothing to fear. If you ever have to go down to an IRS audit or deal with that, keep in mind you're dealing with like real people. And so, there is some reasonableness that is allowed at the IRS. I do think we're going to see some increased audits, more so than we've seen probably in the last 5 years. But, we have an election year coming up, and depending on what administration is in there, they may back off on it or they may continue to accelerate that.
Yeah. So that's another question I had for you is our tax system federally is based largely on what party is in the White House. And the White House tends to go from blue to red to blue to red to blue to red over time. And the ground underneath our feet from a tax perspective tends to shift. Obama was in office, then Trump was in office. He reversed a lot of the stuff that Obama had done. Now, now Biden is in office. He was not able to successfully pass tax legislation. He tried a couple times. Now, depending on the result of 24's election, this might change underneath our feet again. And even if it doesn't, Trump's tax cut is set to expire and sunset starting in 2026, I believe, right? So from a long-term planning perspective, how do you deal with that? How do you think about that, knowing that the parameters that you have to deal with as a professional are constantly changing?
Yeah, tax law is always going to change, and you're always going to need good people in your corner to advise you when it comes to the tax law. But I can't predict the future and what's going to happen. But what I do know is we've printed 40% of all the dollars in circulation in the last 3 or 4 years with all of the COVID money. There's articles out there that Social Security is supposed to expire in 2034. The former comptroller of the United States, David Walker, was the CPA of the United States under President Clinton and President Bush, has come out and said, in order for us to, continue to fund the government and all these programs, we're going to have to double the tax rate, which is, political suicide for a lot of these folks. So what does that mean, doubling the tax rate? Well, in the United States, we have a progressive tax system. So you have a tranche of money, the first $12,000 is taxed at 0%, and then 12,000 to 40,000 is taxed at 10, and then it goes up from there. So what's going to happen is the majority of Americans are going to probably pay about 50% in federal taxes, and then you've got your state taxes on top of that, if that prophecy, I guess, comes to fruition. And so we really want to help our clients save money, not only now, but in the future. So, how are they investing current dollars earned? Are they going to earn more money in the future? Are they going to earn less money? And we really have to plan for that.
Realistically, how likely do you think it is that the tax rate doubles as a result of federal deficits and money printing?
Well, I mean, the tax code really has only changed in a large scale. I guess twice in my lifetime. We had Ronald Reagan was able to make some tax reform changes, and President Trump had some large scale tax revisions. President Obama had some small tweaks with the Obamacare, but it was just, it kind of kept going with the Bush tax cuts, I guess, for the most part. So I think it's really, really hard to change the tax laws here in this country. So And if we're only changing the tax laws every 30 or 40 years, I don't know what's going to happen. But I do know on January 1st, 2026, my tax rate's going up.
Yep. Totally agree with you there. We've looked at that in our office quite a bit over the years, and historically, if you're running a government, it is prudent, I think, to spend a little bit more than you're taking in from tax receipts. Governments are different than households, right? If you or I did that, we would be in credit card debt pretty soon, and then we'd be out on the street at some point if we didn't reverse course. Governments are different. Their time horizon is way longer. They can issue debt to international parties, and they can spend a little bit more than they take in. Not in the way that we have, right? But in manageable amounts. But at some point, the level of debt service, the level of interest, the amount of interest that you have to pay every single year to service the debts that you take on by spending a little bit more than you take in becomes challenging. And with higher interest rates, that's a problem, right? So if you're a legislator and you're in this position, there are only a couple of solutions. One of them is you could raise taxes and bring in more revenues, maybe pay down the debts or at least not take on as much debt. Another one would be to spend less money as a federal government, something that we also don't like to do very much. A third would be stoke the economy somehow, to have some kind of policy to have more throughput in the existing tax system. You have more GDP coming through the existing tax rates. That means that more revenue will be produced to the federal government. That helps, right? Those are all options. But politically, I think that raising taxes is probably the least favorable. And when you're trying to get elected every 2 years or 4 years or 6 years, that poses kind of a problem to your political career. Spending less money is probably the second less desirable one, or the second most to get you like not reelected to the office that you hold. And so personally, I think I agree, and I'm fully expecting tax rates to go up a little bit in 2026 as they revert back to the previous regime. But I think it's just quite a stretch to double that. Something catastrophic would have to happen to get enough support to double the tax rates to balance those scales. And the other way, and the other option that I omitted, was you just print more money, and that's something that's we like to do. We have done a lot in the last couple of years, as you pointed out, and is usually the first shoe to drop there. So, yeah, there's a lot of things to think about. So changing gears again, Jeff, where do you want to take your business? How long have you had the firm open? What does the vision look like for you over the next 5 to 10 years?
Yeah, that's a great question. So we've been in business for 6 years. I'm still relatively young, 41 years old. So, I'll at least be doing this for another 20 to 25 years. I really enjoy what I'm doing, helping business owners create additional cash flow, create a long-term wealth legacy for them and their families. That's really on my heart because, I don't think the government spends your money better than you do. And so I want to make sure that you have as much money as possible to do whatever you want with. And that's really my goal. So our goal really is we want to help 1,000 businesses over the next 10 years achieve that and achieve those goals of, being able to pass on generational wealth. And I think a lot of people can't sometimes see past tomorrow. But that's why we're here, is to help you hold your hand and get it to the point where you can have generational wealth for your kids, grandkids, and their grandkids for a long time. Our school systems are broken. They're not teaching taxes and finances and debt in school. And, it's time to educate a new generation and teach them the power of money, the power of, interest and the rule of 72.
Yeah. I concur wholeheartedly. I really wish they would replace some of the curriculum in high school with some basic personal finance. I think we'd all be better off for it.
Yeah.
Well, this is great. I really appreciate you taking some time out of your week to enlighten us a little bit on these issues, Jeff. Where can people find you? Where should we direct our listeners to engage with you?
Yeah, if you're just looking for some weekly tax tips and want to get to know us more, you can check us out on the Jeff Trapp podcast on Apple or Spotify. And if you're ready for a tax consultation, head on over to thetaxplanningpros.com and we'll get you booked in and see if we can help you save some money.
Right on. Well, thanks again, Jeff. This has been great.
All right. Thank you, Grant. I really appreciate it.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.